Hello, hello, hello. Welcome to Al Stock Trades. In this video, we're going to go ahead and talk about Clover Health and a particular buyer that just recently filed an SEC 13F. This is a big deal, and I want to bring it up to your attention. Now, I know that somebody on the Reddit page brought this up, and others who've been in the market for quite some time realize that this is actually a big deal. Okay. Uh, a hedge fund that makes a move like this makes so based off of data. So we're going to go ahead and talk about it. But first, I want to go ahead and share the screen with you. This is going to be try to make this a very quick video here. Okay. So as you can see here, I've basically, BlackRock, all of them, I'm not paying attention to them. I'm paying attention to like top investors here. Okay. So in March 31st, we have Bally Gifford. They went ahead and they purchased Clove anywhere between the $7 to $15, $16 at an average price of $11. They had about a $56 million worth of shares at the time. Okay. Then we had this guy named Paul. Paul is a very well-known American investor. But I feel like Paul was just clowning around here. He went ahead and purchased about $500,000 worth of Clover, and then like literally 3 months later, he like sold out. And it seems to me that he maybe was trying to go into like the short squeeze. I don't know what he was trying to do here, but he sold out. And then Bally Gifford added even more shares at a lower price, bringing up their total share count to 77 million. And then Paul came in, bought some more this time. He bought more shares, and then Paul sold out again. I don't know what the hell Paul is doing here. He's just going back and forth. And then Bally Gifford went ahead and reduced its position by 66%. Now they sold around $6 million worth of shares. And if you were to back calculate it, which we did, that's a tax loss of $27 million, which then after 30 days and whatnot next year, they're going to most likely increase their position. And it's just part of the tax loss harvesting process, and they're going to most likely get in at a cheaper price. But if you look at this, I skipped over somebody here, Jim Simmons or Simons. Mr. Jim here is the leader of Renaissance Technology. If you haven't heard of these people are one of a kind. And we're going to play a video right now to teach you who these people are. So Jim Simmons went ahead, placed the buy around $2.7 million worth of Clover. Then he came in again, added 70% for $4 million worth of Clover. And then he came in again and added 144% for $10 million worth of Clover. Now let's give you an example here. $10 million worth of Clover. So $6 million worth of Clover is equivalent to a $27 million loss. Now, 12 million is worth approximately, around 56 million, right? So 10 million he's putting in now, and that's equivalent to Bally Gifford's buy-in price at around $11. So this guy is going to at least 5 to 10x his money, which is equivalent to around $100 million. Okay. All right. So we're going to go in and talk about this particular hedge fund. So we're going to, without further ado, let me put on my headphones really quickly. And we're going to increase the speed here, and then we'll link the documentary down below, and we're going to react to it, and then you can watch the rest of it. We just kind of give you an idea here, okay? Hello, 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 hello. Okay, good, good, good. Let's go ahead and remove this. Share screen. All right. All right, let me know if you hear it.
Renaissance Technologies is the most profitable hedge fund in history.
This is probably the single most successful hedge fund in the history of the industry. in terms of its performance record?
Right. So you got to remember he charges a lot, but before fees, 66% on average since 1988.
Behind the firm's wild success are a series of mathematical models and powerful computers.
The quantitative models at Renaissance Technologies are constantly being updated. But what's more important than those models are the ways and methods that are used to discover trading signals.
Jim Simons, the founder of Renaissance Technologies, is a legendary mathematician. He pioneered a unique way of research and model building to the world of hedge funds. He's worth $21 billion, making him the highest earning hedge fund manager in the world. Born and raised in Brookline, Massachusetts, Jim Simons always knew that he wanted to be a mathematician.
We used to go to a delicatessen late at night when I was a student. And one day I saw Ambrose and Singer come in late at night, and they were obviously doing mathematics. And I saw this on a number of occasions, and I thought, boy, that's the greatest job in the world, when you can just hang out at a delicatessen and do mathematics.
Simons enrolled at MIT and even skipped the first year of mathematics thanks to advanced placement courses he took in high school. Simons' academic career was very smooth, and after earning his PhD, he quickly became a professor of math and also took a job as a Cold War codebreaker. But he yearns for more, particularly more money.
Growing up in a middle-class family, Simons always wanted to get rich. Unlike other people in the academics who don't really care about money, Simons, on the other hand, knew exactly how to make money. Start businesses.
While still at school, he started a business with his South American classmates. They decided to start a factory to produce vinyl floor tile and PVC piping.
Well, I met some.
We're going to go ahead and fast forward to this, and we're going to get to kind of the meat of it.
For years after starting Money Metrics, Simons...
So a lot of people on our Mastering Stock Market course have mentioned a concept called mean reversion. It used to work back in the 80s and 90s. It still has its point of view, but mean reversion, as you will see in the documentary, when compounded with free cash flow and historical trends with some assumptions, we'll be showing you guys mean reversions per particular stocks to essentially help you to see whether they're undervalued or overvalued. And again, you add it to all the other data points. So it's actually a great tool.
Simons relied on intuition and fundamentals to trade. It was a great time to be in finance.
The fund is doing so well, he didn't really have to change his approach. But in the back of his mind, he was wondering, can he use the mathematics to model asset prices?
But Simons was getting tired of the fundamental trading.
We did very well, but it was a gut-wrenching experience. It's one day you walk in and you think you're a genius. Oh, my positions are in my way. Look, and the next day you walk in and they're against you and you feel you're a dope. How could I have done what I did and so on? There was no rhyme or reason. It was just, you put your finger in the air and you try to sense which way the wind is blowing.
Simons quickly started working on his first model. With the help of his colleague, Lenny Val, they built a simple mean reversion model. Buy currencies if they moved a certain level below the recent trend line, and sell if they veer too far above it.
The idea of mean reversion is very simple. Suppose you're a farmer and the average price of corn is $5 a bushel. Now, some days it may be $6 a bushel, other days it may be $3 a bushel. But in the long run, these prices will revert back to the mean value. This is what's called mean reversion. Back in the 80s, many commodities were priced like this. Now, his model would not work today, but back in the 80s, this was a revolutionary idea.
They quickly expanded the strategy beyond currency trading. By 1982, he changed the company's name to Renaissance Technologies. But soon enough, their simple mean reversion strategy started to fail. Simple mean reversion is not sufficient anymore, as other competitors started to build their models. To stay ahead of the game, Simons had to hire more talents.
This is what really separates Jim Simons apart from other hedge fund managers. When he sees a problem, he knows exactly who will be able to solve it.
He immediately brought another renowned mathematician, Jim X, to develop a new strategy.
When Jim X looked at those asset prices, he noticed that it is a stochastic process, which is also called a random process. And he believed that using mathematical representation is the best way to model those stochastic processes. When people hear about the word random, they think that it's not predictable. But that's not the case in mathematics. Suppose you throw a dice, and you know each side will come up with a probability, and you can bet on those probabilities.
To model the stochastic process, they start using machine learning.
Machine learning is such a buzzword today, but in the 1980s, most hedge fund managers don't even know what that means, and they still use their gut to trade. But here's the Renaissance technology.
And that's exactly what we're bringing to all stock trades. Now, a lot of you guys know we already have Monte Carlo simulation sequences, and we have a lot of things that you're like, well, what is this in our platform? We recently just put on a quantitative back testing of 15 to 16 years of data, which shows us that we've 10x'd a particular strategy on by analyzing hedge funds. So we've entered this realm, and I can't wait to share it with you guys. So it's actually going to be really interesting. Back in the day, it was hard to get our hands on computive power to essentially do this type of mathematics to use it in finance. But now with technology becoming a little bit more cheaper, it's starting to become more accessible.
technologies ahead of everybody else already started to use machine learning.
The style of machine learning that rentech used was the kernel method. The kernel used a class of algorithms to do pattern analysis. The main tool used in academic finance is linear regression. To this day, linear regression is used to build forecasting models. But the problem is the movement of asset prices is nonlinear. So rather than use linear regression, rentech decided to build nonlinear models to predict price movements. Simons at the time was proposing building an early machine learning system. This model would generate predictions for various commodity prices based on complex patterns, clusters, and correlations that'd be very hard for the naked eye to see. Once again, they were so ahead of their time. This kernel was like a black box that suggested trades that people couldn't even understand.
When the team started testing the model, they quickly see great returns. The firm began incorporating higher-dimensional kernel regression approaches.
Higher dimensional kernels work best for trending models. They're great at predicting how long a trend will last.
At this point, Simons had put up millions to this automated trading system. They call it the Medallion Fund. The Simons saw more potential improvement. He started investing heavily in bringing more mathematical talents.
With the Gen X model, Renaissance Technology started to combine trend following with mean reversion.
The model has generated about 20% annual returns, which is a great performance considering most of the hedge funds made less than 12%. But Simons wanted better. He brought out another brilliant mathematician, Alan Berlekamp. Alan Berlekamp's specialty was game and information theory. He immediately suggested to focus on shorter-term trades to reduce risk by going in and out quickly. Simons took his advice and started focusing on shorter-term approach.
They do a very different approach. It's all patterns, it's all short term. It's not high frequency, but it's something very distinct from what everybody else is doing.
Now Berlekamp became fully in charge of the Medallion Fund. He started fully implementing his ideas. He argued they should learn to handle trades like casinos.
A casino doesn't care about any particular bet. Even if you win like 10 times, a casino is happy because it knows that in the long run, the casino has the statistical advantage. This is what's called the law of large numbers. I think what rentech adopted was the Kelly criterion. This is what we call the scientific gambling method. To put it simply, it's your bet should be proportional to how confident you are in your bet. The formula is your expected net winnings divided by your net winnings if you win.
I think this is actually the secret sauce for Renaissance Technologies. They utilize
Exactly. And if you can look at why they've been doubling down on Clover Health, you can see that the level of risk and reward is outweighed, and we're approaching literally book value costs. And when you get to that level, the margin of safety is literally 90% plus.
massive compute power combined with the scientific approach and to discover trading patterns and validate them and trade based on them. They keep collecting the patterns and anomalies, and that's how they stay ahead of the game.
Well, any one anomaly might be a random thing. However, if you have enough data, you can tell that it's not. So you can see an anomaly that's persisted for a sufficiently long time, so the probability of it being random is not high. But these things fade after a while. Anomalies can get washed out, so you have to keep on top of this.
The firm implemented this new approach in late 1989 with a $27 million Simons had put up. The results were almost immediate and startling. They did more trading than ever, cutting Medallion's average holding time to just a day and a half, and from a week and a half, scoring profits almost every day. The Medallion scored a gain of 55.9% in 1990. The incredible streak has begun. Simon's personal wealth soared. He's never hesitant to pay his employee a lot of money.
So Simons bought a yacht. Every year he would bring his...
All right, this other yacht business and stuff we're not really interested in. Obviously, there's a little bit more good data here. But again, I'm trying to keep the video short. If you guys want to learn more about it, you can watch this video here. I'll link it down below here so you guys can see. There it is. Now, what's important that I want to go ahead and share with you guys is the screen here. Is this particular back-tested model. So Al Stock Trades is essentially the Al Stock Alerts platform. We will be increasing prices post the new year. So definitely I wanted to basically get your attention to this. So we created this backtest model, which essentially creates and puts different strategies of different stocks that it holds. Now, again, we made a video about this, but just to very quickly show you here, if you look at this particular model platform here, you can see that since 2006, it gives you a set of criteria of stocks, and it keeps giving you these stocks every single year until, obviously the back tested model until 2022. The question is, how did it perform? The blue line is the essential back tested portfolio. The NASDAQ is here, and the S&P 500 with the Russell and the Dow are down here. As you can see, the portfolio smoked the crap out of the index funds. And this is the averages here. So you have literally in 2006, you have 11% versus 13%. Anywho, yada, 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 go all the way down the overall 10x versus 215, 2x on the S&P. So we're entering this realm. And what's going to end up happening is every year we're going to be putting a set of stocks, and then we're going to have we're going to have hedge fund data, which will give you stocks every quarter. Because again, the SEC 13 have filings, they might buy new stocks, they may double down on stocks, and it's important to essentially see what's going on. And what you can do is utilize your intrinsic value calculation with Brain Machine and really go and do a deep dive on these particular people's stocks. And I think this is going to be extremely powerful. Again, this type of data is very hard to get your hands on, and it's extremely expensive for the retail investor. So I'm very excited to bring it to our members. In this regards, Renaissance Technology, Jim, again, this is the guy. He continued to keep adding to his position back on March 31st of 2022. Then again, in June, then again in September. So we're going to see right now if they're going to continue doing it, but this is exactly what you want to see. Let me go ahead and see if there are any questions here. Clover really collapsing lately, unusual. Yeah, I mean, honestly, because nothing's really unusual about it. You know, if you go to SoFi and go all other stocks that are unprofitable, they're not doing well because, again, the stock market is prioritizing profitability. What's changed since the earnings report that we had before? And better yet, what's changed since last year? Not really much, to be quite frankly honest. Not really much, guys. Not really much. It's just cheaper prices to get at. And it's definitely an opportunity because once they do become free cash flow positive and profitable, then, they're going to do great. Now, again, I'm really uncomfortable with these types of companies that are unprofitable, but the beautiful part about healthcare is you have an enormous tailwind. And that is every single day, a tailwind is supporting the business, right? Every single day, you have 10,000 Americans turning 65 years of age. 10,000 Americans. Obviously, that right there adds so much value to the proposition of what Clover is trying to solve here. And when you give patients or future consumers of patients more options, which is with their PPO plan, they're most likely going to pick Clover over the rest. So it's actually really good. And they just recently got a new CFO that just like literally less than 3 to 4 months. And 3 months ago, and we just literally heard him speak a couple weeks ago, and it was really great. So I would say patience is a virtue. Patience is key right now. And honestly, I welcome these dips and I welcome these crashes. This is great. Okay. So overall, thank you so much for joining, and I'll see you on the next one.